This episode was recorded using a slick new software called Callin. It's an app in the App Store. Download it, Callin. Follow me at Sweaty Startup, and you can go on your phone, you can listen to the show, and you can actually call in and ask me questions. Enjoy this episode. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show.
Hey, Scott, you're live. Click the little unmute. Gotcha.
All right. Hey, how's it going, Nick?
I'm good. Thanks for listening to all that. What are your thoughts?
For sure. You know, I was sitting there, and those are all really good thoughts on when it comes to revenue management. The only question I can really come up with doesn't have anything to do with it, though. So I was kind of holding back, not wanting to change the topic too bad. But what I've got for you is I'm an LP investor in a few syndicates, and I'm always watching the deals coming across the table. And lately, even with the rising interest rates, I see a lot of these underwriting coming back, and they're planning on 3 to 5 years down the road from now, they're still planning to exit. A lot of these are multifamily properties. They're planning to exit at even 4.25 caps, and I just look at that thinking that seems optimistic. I mean, maybe today or in the last couple of years you could plan for that, but that just seems a little ambitious to plan for that 3 to 5 years from now, given the uncertainty of where we're going with rates and everything. I was just wondering what your thoughts are on that.
Yeah, so it's not necessarily a sponsor's job to think and plan and project that things are going to change drastically. Does that make sense?
Sure.
It's not the sponsor's job to look at real estate and say, oh man, if hell freezes over and things get really hard, we might have to sell this thing at a 5.5 cap and lose money. Or not necessarily lose money, but the IRR would be crushed, right? It might only be 5, 7, 9, 10% IRR, 25, 30, whatever they might be projected. Now, so that's something that you as an investor need to decide in general on real estate is now when I want to invest in real estate. And then you can ask the questions, and this is what I spend my time thinking about and protecting the downside and thinking about what could happen. You need to ask the questions of the sponsor, hey, what if? Or ask yourself, look at their model and say, what if? What if we exited at a 5.5 cap? Or what if we couldn't exit at all? What if the 5-year time horizon became a 10-year time horizon? What if? And when you ask those questions, you start to really see where the risk lies in a deal. Okay, if I can't sell at a 4.5 cap, which is market now, what would happen? If I can't refi at 4.25% interest rates, which are now, and I need to refinance at a 7% interest rate, what happens? And that's my job as a sponsor to protect the downside. So if an LP asks me, Nick, what do you really think about interest rates and what could happen here? Obviously, I don't know. Nobody knows what's going to happen to interest rates. If I could predict interest rates with certainty, I wouldn't be buying real estate. I would be opening a hedge fund and making millions and billions of dollars because I can predict interest rates. My job is not to predict them. My job as a sponsor is to make sure that if they go up, if interest rates go way up and cap rates go way up, we're not going to lose our ass. We're not going to lose our money. The downside is protected. We can continue to operate the buildings. If we can't sell 5 years from now, that's fine. My team is good. My management company is alive and well. It's paying the bills. It's profitable. I can continue to pay my people through downturns. That's one huge thing when you're looking at these deals is, okay, can the company who's putting out this deal, can they afford to pay their people well if they're not doing deals? And the answer is many times no. And that's a red flag for me because that opens up some downside risk. If things get really hard, this group I'm working with can't afford to pay their people. How the hell are they going to manage this asset well through a downturn? If we end up working for 10 years together. But if you start to ask these questions as you look through a deck, and a good deck will answer them, but a bad deck won't. I'm seeing a lot of decks now that don't even have preferred returns and promotes listed on the deck, so you don't even know the fee structure or how the waterfall works when you look at a 25-page OM. But you kind of understand where I'm going with this. It's not Yeah, elaborate a little more, and I'll give some more thoughts, because I definitely we can have a good conversation around this.
Yeah, I absolutely hear what you're saying. For example, a lot of the deals I've been seeing lately, they are kind of banking on that exit, and that's where
Hmm.
most of the money's being made. There might be a
Hmm.
little bit of cash flow over the life of the deal, but the majority's on the exit, and so that all looks great if you can count on a 4.5 cap. But yeah, then I start taking a look at, okay, what about a 5.5 cap? And pretty soon it's like, oh, we're not making a nickel on this thing, or there goes most, if not all, the profit at the end. So
Hmm.
I see that, and I just think I tend to be fairly conservative. I like to see deals underwritten in a conservative manner,
Hmm.
and then if there's more upside at the end, then all the better. But I want to see it still hold up in a kind of worst case scenario situation.
Hmm.
So a lot of these deals I'm seeing, they just don't pass that smell test. A lot of them are just not holding up to that. So I've been hanging on and just waiting, for the next one and the next one and the
Yep.
next one. And I just feel like I'm seeing this trend of pretty optimistic projections on what they think is going to happen. And and if their assumptions are correct, then yeah, it's going to be a good deal and it's going to work out. But it doesn't leave a whole lot of wiggle room for things to start going south on them. And I feel like in the last 6 months or so, there's been more and more of that. Where in the past, I was seeing a lot of more deals that were a little more on the conservative side, which is, like I said, what I like to see.
Yeah, the conservative underwriters are not winning deals right now. Period. We
Okay.
are not winning very many deals, and neither are groups who are modeling a 6 cap exit. You know, you can't. So what we're doing instead is protecting the downside. And okay, we'll model the exit cap where it is now, or maybe 50 basis points wider than it is now, because rates are clearly going up. And yes, we'll model having to get debt that amortizes at 6% interest rates, when we refinance. So, we're modeling not getting good debt. We're modeling, a cap rate that's maybe 50 basis points higher than it is right now. But it's not our job to model and put in front of an LP a projection that is a doomsday scenario. That's not our job. Our job is to protect against that doomsday scenario, so that if it happens, we're not going to lose the property, and we don't need to sell it, and we can hold it until the market corrects. And yes, we have cash flow. So for us, it's to protect that downside. It's a couple of things. It's less leverage altogether, meaning instead of levering up 70% leverage, where you could be in real trouble if you need to sell at a lower price than what you have now, okay, maybe we only use 50% leverage and 50% cash, and that might hurt our cash on cash a little bit, but it'll still be there, and we're not going to lose this asset. And then another thing is find markets where we can really flex our operational muscles, because operationally, just like I was saying, we are very, very good at driving revenue. We're very, very good at leasing, and we're very, very good at maximizing the amount of revenue that we can get per square foot on a property. So we need to be really picky. And if we're going to stretch on a deal, we're going to stretch on a deal in a market that is fully occupied. We just did a deal in Virginia. We closed last week. Everybody in town's full. We think they're charging half of what true market rent is. We don't know. Obviously, we're not going to underwrite that, but there's a really good chance, and we're already seeing it. There's a really good chance that we're going to raise rents $40, $50, or 60, 70%, and nobody's going to move out because nobody's done the work to find true market rent. And that's where, okay, a clear operational value add strategy really matters in this kind of environment.
All right.
Scott, I really appreciate it. Thanks for calling
Yeah.
in. But yeah,
Yeah. Thank you, Nick.
as an LP, it's never been a more important time than to ask yourself, do I really think interest rates are going to stay where they are? Do I really think demand is going to keep roaring? Do I really think cap rates upon exit are going to be where they are now? And if the answer to those three questions are no, then it's probably not a good time to be an LP investor unless the GP has a really clear value add strategy and a mission that you can really believe in. So that's kind of where I am. But there's still deals out there. There always will be deals out there in any environment. And my job as a GP is not to project a home run, and my job as a GP is not to project a doomsday scenario. It's to protect against it and to try to make the home run happen and to protect against the downside, but show my LPs what's likely to happen if things stay similar to what they are now. So
Yeah, that all makes sense, and yeah, I agree with you on how to be looking at this from the LP side. I think you're spot on the criteria it needs to hit, and
mm-hmm.
that's how I'm trying to think about it. It's just it's been interesting. Like as I don't need to tell you, it's been interesting these last few months for sure.
Yeah, and when I'm on the phone with an LP, sometimes it's not a good fit. If an LP is asking, okay, when can you return the capital? What are we going to sell this thing for? What's the IRR going to be? I spend a lot of time on the call talking about, okay, listen, I mean, we have a rosy picture here painted, and because it's been rosy for 10 years in the self-storage business. If things go how they are, this is going to be great, and this is what's likely going to happen. But let's not talk about that. Let's talk about what happens here if interest rates go to 6.5% or 7%. If banks get cold feet and we have to get amortizing debt that are not good terms, and our debt constant, our debt costs are 7-8%. And what happens if our exit cap is not there and we got to hold on to this thing for 10 years? How do you feel about that as an LP? Would you feel comfortable giving me this cash, maybe $100,000, maybe $500,000, maybe $1 million? Would you feel comfortable giving me this cash, knowing that we might miss all these projections because the economy is really fragile right now. Demand might, not keep up to what, where it is now. It might actually fall off. The refinance debt that we might be able to get is not going to be nearly as good as what we think. Okay, cap rate might not be there for us to sell the thing. We might hold it for a long time. So our 25 IRR or our 15 IRR 3 to 5 year hold deal might turn into a 7 IRR 10-year hold. How do you feel about that? Are you okay with that? Do you need this cash back? Do you trust me? Do you want to be invested in storage for 10 years? Because that might be where we are in a little while. So that's kind of how I think about it.
No, and that's good. You're kind of putting all the possibilities out in front of them, and I think that's what makes a good sponsor. Is you're taking care of your LPs, making sure they're thinking of all those possible scenarios. So that's good to hear.
Mm-hmm. I appreciate it, Scott. Have a great night.
You too. Thank you, Nick.
Thanks for calling in.
Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group to get some momentum get $200 off the annual membership using the code FIRST299, FIRST 299. And also you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.